couple in Barrie, Ontario closed on their first home in September 2022. They saved for 6 years. They scraped together the down payment, paid the land transfer tax, paid the legal fees, and then they proceeded to pay for other necessary costs. Paid the home inspection, ensuring the house foundation was solid. Paid the moving company to carefully transport their furniture. By the time they turned the key on their front door, they had spent every dollar they had budgeted and several they hadn't. 8 months later, a coworker mentioned something at lunch. They were talking about financial support. They were told about a federal tax credit available to them. First-time home buyers, up to $10,000. The couple went home that night and looked it up. They qualified. They had qualified from the day they signed. Nobody at their bank told them. Nobody at their mortgage brokerage told them. Their real estate agent never mentioned it. Their lawyer, who charged them $1,800 to close the transaction, said nothing. They filed an adjustment to their tax return. They got $1,500 back, not $10,000. $1,500. A significant difference from what they expected, because they did not understand the difference between a tax credit and a tax refund, and nobody explained it to them. And they left the rest of the benefit unclaimed through a misunderstanding that took 4 minutes to correct once someone finally explained how the credit actually works. They did not know. Every professional they paid through that transaction knew, or should have known. Nobody said a word. The silence from the professionals was deafening. That is not bad luck. That is the system at work. To understand how badly the system is failing first-time buyers right now, you have to understand what the support framework was built to do. Home ownership in Canada has been a stated federal policy priority since the post-war era. The federal government built the Canada Mortgage and Housing Corporation, the CMHC, in 1946 specifically to make home ownership accessible to returning veterans and working Canadians who could not afford to purchase without institutional support. The underlying principle was straightforward. Stable home ownership produces stable communities, stable tax bases, and stable economies. Support first-time buyers, and you get more of it. For decades, the framework functioned adequately. Mortgage insurance through the CMHC allowed buyers with less than 20% down to access financing. Interest rates were regulated. Home prices, while rising, rose at a pace that kept ownership within reach for a median-income Canadian household. Then two things happened simultaneously, and they broke everything. The system could not sustain it. Home prices detached from income. Between 2000 and 2023, the average Canadian home price increased by over 375%. The average Canadian household income increased by approximately 80% over the same period. The ratio of home price to household income, the fundamental measure of housing affordability, went from roughly 4 times annual income to over 9 times annual income in major markets. Toronto and Vancouver crossed 12 times income. The math stopped working, and it has not come back. And the support programs stopped scaling with the problem. The first home buyer's tax credit was introduced in 2009 at a maximum claim of $5,000, which generated a $750 tax credit. It was doubled to a $10,000 claim in 2022, generating a maximum $1,500 credit. A necessary adjustment. In 2009, $750 represented a meaningful fraction of the closing costs on a median home purchase. Prices were different then. In 2025, $1,500 against closing costs that routinely exceed $30,000 to $50,000 on a Toronto or Vancouver purchase represents a gesture. A well-intentioned, documented, legally available gesture, but a gesture. None of that means you should not claim it. Every dollar is a dollar. Every penny counts in this economy. And the HBTC is one of 5 distinct federal and provincial programs available to first-time buyers. Programs that stack, that combine, and that together can reduce your first home purchase costs by significantly more than any single program suggests. Today I am going to walk you through all of them, in order of financial impact. With the exact numbers, you need to claim them correctly. Let's start with the credit in the title of this video, because even though it is the most publicized of the first-time buyer programs, it is still the one most commonly claimed incorrectly or not claimed at all. The first home buyer's tax credit. Officially, the home buyer's amount on line 31270 of your federal tax return allows a first-time home buyer to claim up to $10,000 on the tax return for the year in which they purchased their home. Here is the number that matters. The credit is calculated at 15% of the claimed amount. 15% of $10,000 is $1,500. That is the maximum federal tax reduction available under this credit, not a $10,000 refund, a $1,500 reduction in the federal tax you owe. This distinction between the claim amount and the credit value is the source of the confusion the couple in Barrie experienced. When a program is described as a $10,000 credit, the natural interpretation is $10,000 back. The actual value is $1,500 off your federal tax bill. If you owe less than $1,500 in federal tax for the year of your purchase, you cannot carry the unused portion forward. You lose it. The credit is non-refundable. Who qualifies? You must be a first-time home buyer, defined by the CRA as someone who has not owned and lived in a home as their principal residence at any point in the calendar year of the purchase or in any of the 4 preceding calendar years. Note that definition carefully. If you owned a home 5 years ago and sold it, you may qualify again. The 4-year look-back is precise. You must have purchased a qualifying home, a property in Canada that you intend to occupy as your principal residence. This includes detached homes, semi-detached homes, townhouses, condominiums, cooperative housing units, and mobile homes on a permanent foundation. The credit can be split between spouses or common law partners, but the combined claim cannot exceed $10,000 total. If you and your partner both file, you divide the $10,000 however you choose between your 2 returns, provided the total does not exceed $10,000. Where do you claim it? Line 31270 on Schedule 1 of your Federal T1 General Return. If you purchased your home in 2024 and did not claim it, you can file a T1 adjustment, a T1 80J form, to amend your 2024 return and add the claim retroactively. The CRA allows adjustments up to 10 years back. If you purchased a qualifying home as far back as 2015 and never claimed the home buyer's amount, you can amend those returns and claim what you missed 10 years back. File the adjustment. Get the money. Success is just a form away. If the home buyer's tax credit is the program most Canadians skip after their purchase, the First Home Savings Account is the program most future first-time buyers are not using before their purchase, and the financial impact of missing it dwarfs the $1,500 HBTC entirely. The First Home Savings Account, the FHSA, was introduced by the federal government in 2023. It is the most significant new financial tool for first-time buyers introduced in Canada in decades, and the majority of eligible Canadians have not opened one. Here is what it does in concrete terms. The FHSA allows a first-time home buyer to contribute up to $8,000 per year to a maximum lifetime contribution of $40,000 into a registered account. Those contributions are tax-deductible. They reduce your taxable income in the year you contribute, exactly like RRSP contributions. If you are in a 40% marginal tax bracket and you contribute $8,000 to your FHSA, your federal and provincial income tax bill drops by approximately $3,200 in that year alone. The money inside the FHSA grows tax-free. Interest, dividends, capital gains, none of it is taxed while it sits in the account. And when you withdraw the funds to purchase your first home, the withdrawal is completely tax-free. You do not pay tax on the contributions when you put them in because they were deductible. You do not pay tax on the growth. You do not pay tax on the withdrawal. That is the full tax elimination on savings you are using toward your first home. No other registered account in Canada offers that combination. On the maximum $40,000 lifetime contribution, a Canadian in a 40% combined federal-provincial marginal rate saves approximately $16,000 in income tax on the contributions alone. On top of that, the tax-free growth on $40,000 invested over several years, assuming a conservative 5% annual return, adds several thousand more. The total financial advantage of maximizing an FHSA before purchasing can easily reach $20,000 to $25,000 compared to saving the same money in a regular account. If you have not purchased a home yet and you are planning to, you need to open an FHSA today. Not next month. Today. Every year you delay is lost room. You can open an FHSA at any major Canadian bank, credit union, or online brokerage. It takes 15 minutes. The annual contribution limit is $8,000. Unused room from 1 year carries forward, but only 1 year. Miss 2024, and you can catch up in 2025 with $16,000. Miss 2023 and 2024, and you cannot contribute $24,000 in 2025. You are capped at $16,000. Open it. Fund it. Every dollar in that account is working harder than any dollar anywhere else in your financial life. The Home Buyers Plan, the HBP, has existed since 1992, and it is still one of the most underused programs available to first-time buyers in Canada. Not because it is obscure, because it is misunderstood. The Home Buyers Plan allows a first-time home buyer, using the same 4-year look-back definition we discussed for the HBTC, to withdraw up to $35,000 from their registered retirement savings plan to use toward the purchase of a first home. The withdrawal is not taxed at the time of withdrawal. You do not pay income tax on $35,000 of RRSP funds when you pull them out under the HBP. If you have a spouse or common law partner who also qualifies as a first-time buyer, they can withdraw up to $35,000 from their own RRSP simultaneously. Combined, you can access up to $70,000 of RRSP savings, tax-free at the time of withdrawal, to apply to your down payment. The repayment requirement is what confuses people and what causes some buyers to dismiss the program. After you withdraw under the HBP, you are required to repay the withdrawn amount back into your RRSP over a 15-year period. The repayment starts 2 years after the year of withdrawal. Each year, 1/15 of the withdrawn amount becomes your minimum repayment. If you fail to make the minimum repayment in a given year, that year's required amount is added to your taxable income. You pay income tax on it, as if you had not repaid it. What this means in practical terms, the HBP is not free money. It is an interest-free loan from your future self, routed through your RRSP. You borrow from your retirement savings today, use it for your down payment, and repay it systematically over the following 15 years. During those 15 years, the money you repay goes back into your RRSP and resumes growing tax-sheltered. Used strategically, particularly when your RRSP has significant accumulated room and your marginal tax rate is high. The HBP is a powerful tool. A buyer who withdraws $35,000 uses it toward a down payment that gets them into a property 2 years earlier than they could have otherwise, and then repays systematically over 15 years, may come out significantly ahead compared to leaving the money in the RRSP and renting for 2 more years while saving the down payment from after-tax income. The FHSA and the HBP can be used together. You can withdraw from both in the same purchase. $35,000 from your RRSP under the HBP plus up to $40,000 from your FHSA. Potentially $75,000 in registered savings applied to a single first home purchase, with the HBP funds repayable over 15 years and the FHSA funds never requiring repayment. If you have RRSP savings and you are planning a first home purchase, speak to a fee-only financial planner about whether the HBP makes sense in your specific situation before you sign a purchase agreement. This one is small, but it is real, it is documented, and almost no first-time buyer has ever been told it exists. If you purchase a home with less than 20% down payment in Canada, you are required to purchase mortgage default insurance through the CMHC, Sagan, or Canada Guarantee. This insurance protects the lender, not you, in the event you default on your mortgage. The premium is calculated as a percentage of your mortgage amount and is typically added to your mortgage balance. On a $500,000 mortgage with 10% down, the CMHC premium is approximately $15,200. You pay that premium. The lender keeps the protection. That is the arrangement. However, CMHC offers a premium refund of up to 25% for homes that meet specific energy efficiency standards. If the home you purchase has a high energy efficiency rating, specifically a Natural Resources Canada EnerGuide rating of 86 or higher, or if you purchase a new home built to an energy efficient standard and have it evaluated, you may be eligible for a partial refund of your CMHC insurance premium. On a $15,200 premium, a 25% refund is $3,800, applied directly back to your mortgage principal. Most buyers who qualify never apply because their mortgage broker never mentioned the program exists. The application is filed through CMHC directly after purchase, with supporting documentation from a certified energy advisor confirming the home's efficiency rating. If you purchased an energy-efficient home or a new build in the past several years and paid CMHC mortgage insurance, check the current eligibility criteria on the CMHC website. The refund program has been modified over time, and the current thresholds may be different from when you purchased, but the program is active and the refund is real. Every federal program we have discussed so far can be combined with provincial first-time buyer programs, and in several provinces those provincial programs are substantial. In Ontario, first-time home buyers are eligible for a full refund of the Ontario land transfer tax on the first $368,000 of a home's purchase price, a maximum refund of $4,000, combined with Toronto's municipal land transfer tax refund, available to first-time buyers in the City of Toronto. The maximum combined provincial and municipal refund reaches $8,475 on a Toronto purchase. Land transfer taxes on a $700,000 Toronto home can exceed $20,000. Getting $8,475 of that back is not trivial, and the majority of first-time buyers in Toronto do not know the municipal refund exists separately from the provincial one. In British Columbia, the First-Time Home Buyers Program provides an exemption from the BC property transfer tax on the first $500,000 of a qualifying home's fair market value. On a home purchased at or below $500,000, the exemption is complete. The full property transfer tax is waived. For homes between $500,000 and $525,000, a partial exemption applies. The BC property transfer tax is calculated at 1% on the first $200,000 and 2% on the balance. On a $500,000 home, that is $8,000 in tax, fully eliminated under the first-time buyer exemption. In Prince Edward Island, qualifying first-time buyers receive a full exemption from the PI land transfer tax. In New Brunswick, a partial rebate is available on the provincial portion of the HST on new home purchases. Quebec operates its own program, the first-time buyer tax credit under the provincial income tax system, which provides a non-refundable credit on the Quebec provincial return in addition to the federal HBTC. The critical point is that provincial programs are administered separately from federal programs. Claiming the federal HBTC on your T1 does not automatically trigger your provincial land transfer tax refund. The Ontario land transfer tax refund is claimed through the Land Registry Office at the time of closing. Your real estate lawyer is supposed to apply it on your behalf. If your lawyer did not apply it, you can apply for it retroactively through the Ontario Ministry of Finance for up to 4 years after the transaction. Ask your lawyer. Confirm it was applied. If it was not, file for the refund. If you purchased a newly constructed home or a substantially renovated home, there is an additional federal rebate that applies exclusively to new housing and that many buyers are not told about until after they have already paid the full tax. The Gulf Standard Time Hawaii Standard Time New Housing Rebate allows buyers of new homes to recover a portion of the GST or the federal part of the HST they paid on the purchase. The rebate is calculated based on the purchase price of the home and phases out as the price increases. For homes purchased at $350,000 or less, the maximum federal rebate is $6,300. For homes between $350,000 and $450,000, the rebate phases out proportionally. For homes above $450,000, no federal new housing rebate applies, though provincial new housing rebates may still be available depending on your province. In Ontario, the provincial component of the HST new housing rebate is available regardless of purchase price. The Ontario new housing rebate is 75% of the provincial portion of the HST paid, to a maximum of $24,000. This is separate from the federal rebate. In British Columbia, a similar provincial new housing rebate applies. Builders of new homes are required to account for these rebates in the purchase transaction. In many cases, the builder factors the rebate into the sale price and receives it on your behalf, meaning the rebate never passes through your hands but is reflected in a lower effective price. In other cases, particularly for custom builds or substantial renovations, the buyer must apply directly to the CRA. If you are purchasing a new build or have purchased one in the past 2 years, confirm with your lawyer and builder exactly how the Gulf Standard Time Hawaii Standard Time new housing rebate was handled in your transaction. If it was not applied and you qualify, a T2091 and GST 190 application to the CRA can recover it retroactively. Whether you are planning a purchase, have purchased recently, or purchased years ago and never claimed everything you were entitled to. Here is exactly what you need to do. If you have not purchased yet, open an FHSA today. Go to your bank, credit union, or online brokerage. Open the account. Contribute whatever you can before December 31st of this year. Every year of contribution room you allow to lapse is permanent. This is the highest impact action a prospective first-time buyer can take right now. If you purchased in the last 10 years and never claimed the home buyer's amount, file a T1 adjustment for every eligible year. Download the T1 ADJ form from the CRA website. Claim line 31270. Get the $1,500 credit applied to those years. 10 years is the window. Check every year you owned a qualifying first home. If you purchased in Ontario and your lawyer did not apply the land transfer tax refund, contact the Ontario Ministry of Finance directly. The retroactive window is 4 years. The maximum refund is $4,000 provincially and up to $4,475 municipally if you are in Toronto. This is not a small number, and it is your money. If you have RRSP savings and a home purchase within the next 5 years, model the home buyer's plan with a fee-only financial planner. The $35,000 tax-free withdrawal combined with a full FHSA contribution can represent a combined $75,000 toward your down payment using registered savings. Run the numbers before you decide it is not worth the repayment obligation. If you purchased a new build, confirm with your lawyer how the Gulf Standard Time/Hawaii Standard Time new housing rebate was handled. If it was not applied, file for it. The window for a CRA application is 2 years from the date of possession. If your new home is energy efficient, apply to CMHC for the mortgage insurance premium refund. The application is on the CMHC website. A certified energy advisor can evaluate your home if you do not already have an EnerGuide rating. On a large mortgage, the refund can exceed $3,000. These programs do not call you. They do not send reminders. They do not follow up. Every single one of them requires you to know they exist and to take a specific action to claim them. The real estate industry, the mortgage industry, and the banking industry have no financial incentive to walk you through this list on the day you sign. That is what this video is for. The couple in Barrie got $1,500 back. They qualified for the Ontario land transfer tax refund, $2,048, that their lawyer never applied. They qualified for the Gulf Standard Time/Hawaii Standard Time new housing rebate on their partially renovated purchase, an additional $4,200 they never claimed. They did not have an FHSA because it did not exist when they purchased. But their younger sibling, who watched them go through the process and started paying attention, opened an FHSA 6 months after the program launched. She is now 2 years in. She has $16,000 in the account. She has paid zero tax on the contributions. She is buying in 2027. She knows what the couple in Barrie did not know on the day they signed. So do you. If this video showed you money you left on the table, file the adjustment, claim the refund, open the account, and send this to anyone you know who is planning to buy or who has bought in the last 10 years without knowing any of this existed. The programs are there. The money is real. The only barrier between you and it is information.